Welcome to the Debit This, Credit That podcast with Wheeler Accountants located in San Jose, California. In this podcast, we discuss how to solve accounting challenges in both your personal life and your business. We take an energetic, tech-savvy approach to solving accounting challenges that steal your focus and your time. Now, on to the show with your tech-savvy accounting experts, Matt Wheeler and Michael Bryant.
Hello and welcome to episode 20. Michael Bryant and I are going to be talking today about donor gift accounting. It is that time of year again where nonprofits are doing what they can to bring in some money before the end of the year. And Michael gets a lot of questions about this. So Michael, let's start off by defining what is the donor gift accounting overall, and then let's jump into what is an unrestricted gift.
Yeah, Matt, today I wanted to talk about gifting and the gifts that my nonprofits are receiving, because I get a lot of questions, and definitely this is a busy time of year for our nonprofits, getting a lot of different donations, and just how to properly record those donations, and just have a little bit of discussion about those types of donations.
Fantastic. Okay, so let's break down those different kinds of donations, or gifts. So what is the unrestricted gift or a unrestricted gift?
An unrestricted gift means that it comes with no donor restrictions. So the nonprofit can use it for any purpose that is in line with their mission statement. So it could be used for operations, anything in general. So unrestricted means just that. There are no donor restrictions with it.
So who sets that up, though? I'm going to get kind of down and dirty with you here. Is that something, do the charities specifically ask for unrestricted gifts? Because that sure does seem to allow them to have a little bit more autonomy over the money coming in.
Yeah, definitely. The nonprofits have management and overhead that they need to support as well. So those unrestricted gifts are really valuable to helping them move their mission forward. So when they ask donors for an unrestricted gift, meaning that donor does not have any requirements around that gift and they can use it for whatever purpose that they feel is appropriate.
Well, then let's do a complete 180 and talk about what a restricted gift is.
Sure, absolutely. So there's different types of restricted gifts. So restricted gifts are always restricted by the donor, meaning that the nonprofit themselves can't determine that it's restricted. It has to be the donor that restricts it. And it can be restricted as a temporary restriction, which means that it's either time or purpose restricted. Or it could be permanently restricted, which means that the principal of the gift, or a lot of times it's considered an endowment, that the principal would be held in perpetuity, and then the income could either further be restricted to be used for purpose, or it could be used for operations. And I can give you a quick example of one of my clients had an endowment that was further restricted. The income was further restricted. So they had an aging building and they had to keep up with a lot of the maintenance. So what they did was they did fundraising for a building endowment, and that building endowment was for repairs and maintenance on the building and potential future replacement of that building. So again, the principal couldn't be used, but any of the income that was generated off of that would be used for building maintenance purposes.
Are there instances which a restricted gift should not be accepted?
That's a great question. And I actually wish that my clients would ask me more often, should we be accepting this gift? Because a lot of times we'll find out later that they've accepted a gift that they shouldn't. So starting out, a nonprofit should have a good policy on gift acceptance. And so making sure that they know what they're getting into. I had one nonprofit that had accepted gifts of land. They had two pieces of property. One of the properties was considered like a landlocked island. It was on top of a mountain, and there was no way to to get to this property. So it was pretty much didn't have any value, and it became a legal nightmare for the nonprofit because they had to pay the property taxes on it, and then they were trying to get out of it and trying to gift it to the county or to get rid of it, and it took a lot of attorney fees, and that gift ended up costing them money. They also accepted a piece of property in the desert of Arizona where basically there was a parcel that was never going to have water, never going to have electricity, and pretty much had no value. And so a nonprofit needs to be careful about gifts that they're accepting. Another example that we just ran across at one of our clients that is up in the Santa Rosa area. We've just been affected by some significant fires. And so there's a lot of money coming in to help fire victims. And this nonprofit felt like, oh, well, we would like to get involved. And they got a large sum of money, but that money was restricted to go directly to fire victims, either with supplies, food, or assistance in rebuilding. And to dispense those funds, that takes overhead. So now this nonprofit has committed to dispensing these funds, but they don't have the resources to be able to completely to disperse those funds. And so now they're taking up their resources, and they can't use any of those monies to cover their overhead.
Wow. The land thing sounds to me like something that you would probably deal with more often than not. And we're not going to point fingers at who's responsible, but I do think it's very vital, obviously, that somebody like you is talked about or talked to about those different kinds of gifts. Now, what about deferral of gifts? Help me with how that works with restricted gifts.
Yeah, so deferred revenue as it relates to restricted gifts is kind of a concept that has gone away a long time ago, but we still run into it from time to time. So very rarely would a nonprofit actually have a deferred revenue as it relates to a restricted gift. Some examples of some deferred revenue that an organization might have is if they're selling tickets for an event at a future time, then that revenue from those tickets would be deferred. And also if they have, if they're unsure if they can actually meet the purpose, meaning that they're accepting a restricted gift and maybe it's not in exact in alignment with their current operations, but maybe they're going to be able to shift and use those gifts, but they're not positive. So if they're unsure and they've received the funds, then that would be deferred revenue. We've ran into some cases where we've taken over audits from previous audit firms that didn't really understand the accounting for nonprofits. And so we'll see these big deferrals because it was time restricted, meaning it was restricted to the next year, and they're treating it as deferred revenue instead of recognizing it as a temporarily restricted that would be released into unrestricted when that time purpose had been met.
Now you're talking about time and just, you know, all of that sort of stuff. How should and when should a gift be recorded?
So a gift should be recorded either when it's granted or when it's received. So if a nonprofit is notified that they are going to be a recipient of a gift, then that should be recorded as a receivable at the time that they're notified and they understand the details and can record that. Other times they don't know that the gift's coming in, and so then when the gift is received, then they would record it. There are some conditional gifts, so that means that the nonprofit has to perform certain measures before they can receive the gift. So in conditional grants or gifts, then those would not be recorded until they have been earned or met, or the conditions have been met.
From an accounting side, on the other end, what needs to happen when a gift is recorded? Do the recipients need to get anything, or help us understand that paper trail a little bit better, if you don't mind?
Yeah, so if a nonprofit receives a gift of more than $250, either in kind or in cash, then they do need to issue a letter or receipt stating that they've received that gift that's valued over $250.
Gotcha. Now, there are different types of gifts. You talked a little bit about the land gifts, the two magnificent land gifts that one of the charities that you work with received. What other kinds of gifts are there?
Yeah, so the most common gift that is received is in cash, but there are other what we call in-kind gifts, and this could be such things as food or property, as we had talked about in the land. Another really common gift, especially here in the Silicon Valley, is stock donations. So what will happen is an individual will gift stock, and typically they're appreciated stock, so they get the write-off on their tax return, and the nonprofit who receives that stock will record it as fair market value on the date of receipt. But one thing with the stock donations that we want to stress to our nonprofits is that they really should be liquidating those stocks as soon as possible, because oftentimes they aren't in alignment with the investment policy that the nonprofit has already established. And it's really just a better idea to liquidate and then invest them, and it makes it easier to do the accounting for it as well.
So liquidate them and put them in line with the investment policy that the charity is adhering to already.
Exactly.
Okay. Well, now that's interesting, because there are something that has been in the news rather recently is a non-traditional type of asset or resource, which is Bitcoin. Help us understand how Bitcoin can play a part, or should it play a part, when it comes to gifts?
Yeah, this has been a really hot topic for us. I've actually received 2 calls this week in regards to Bitcoin. Obviously, Bitcoin is new, and it is an asset. And it has a lot of volatility around it. But I tell my nonprofits that they should accept those Bitcoin donations, and that they have a market. And just like the stock donations, they should be liquidating them as soon as possible, and converting those into cash. And then they can turn those into investments that follow their policies. I would never recommend that one of our nonprofits holds Bitcoin as a investment, just because it is so volatile, and we don't want them to take those sorts of risks with donors' money.
Now, where I live, car and boat donations are something advertised often. I'm assuming it's the same thing where you are. How should a charity handle that in cars specifically?
You know, cars and boats are a little tricky. I definitely recommend if the organization can use the vehicle in their operations, maybe they ask a dealership for a van to transport kids. Certainly, those are very easy to account for, and if as long as that's in line with their operational needs, then they should take those types of gifts. When they're looking at car donations and boat donations, where that car or boat is going to be sold and then they're going to retain the cash, typically, I don't recommend that our nonprofits do that without having a third party involved, just because there's so much overhead and paperwork that goes into it. And so they're really going to want to consult with a good third party that will handle this process for them. But be aware that that should be set up before any type of car donation or boat donations taken in, and that the third parties certainly charge high fees for that. And so there's very good likelihood that maybe they'll only get 50% of the cash that's collected from that car donation.
Ouch.
And one other thing that I like to note is that, most of the time when cars and boats are being donated, the donee is looking to get the value out of it as a write-off on their tax returns. And there's been some changes to the tax law that requires them to only get the value that the vehicle had sold for. So if you do use one of the third-party liquidators and say that they just send everything to auction, a donor might be providing you a vehicle that they say is worth $10,000, and maybe it sells at auction for $3,800, and then that donor is going to come back and be really upset with the organization saying, hey, I only get a donation of $3,800 now when I gave you this $10,000 vehicle. I would have been better off selling it on my own and giving you the cash, which a lot of times might be the recommended route.
When you were talking about a direct donation of a new van or something like that to transport children, what is written off? Is there a fixed negotiation when it comes to the MSRP, or how does that work?
So the dealership would get the donation of the full value of the vehicle, and the recipient, the nonprofit receiving that donation would get the value of the vehicle as a contribution, and they would record that on their books as an asset and then depreciate it over the useful life, which is typically 5 years.
All right. What are we missing? Anything else on donor gift accounting we need to know before the end of the year?
No, I think that we've really covered all the questions that I've been getting in recent times with my clients asking about gift donations. So I appreciate the time today.
Absolutely. And thank you very much for answering those questions. It's very, very timely. And if you would like to get answers like this directly to your listening device, make sure that you subscribe to the podcast, Debit This, Credit That, right below where you're looking right now. That way, also, when the firm comes out with a new podcast, it will be directly delivered to you, and it makes it easier for you to share it with friends and family. And with that, thank you very, very much, Michael. I hope you have a great day.
Thank you. You too, Matt.
And we'll see you all for episode 21 very soon.